Hello and welcome to the Weekly Market Metrics. I'm your host Sandeep and we are in week 12 of 2026. With all the news factored in, the markets seems to have found a base, and after 3 negative weeks, this week could have been positive. But then out of the blue came the news about HDFC Bank's chairman's resignation and the stock cracked 5%, taking all the indexes down with it. Still, most of the indexes ended flat for the week. If you're still on the sidelines, I would say this drop gives a good opportunity for index investors to nibble a bit. Anyways, let's get into the charts and see how the price action unfolded this week. And we will also look at what could be possible in the week ahead. As always, let's start with Nifty first. It was a week full of highs and lows, but in the end, Nifty closed almost flat, losing 37 points or 0.16% to close at 23,114. It may seem that after the biggest fall in over 3 years and 9 months last week, the market has taken a pause when you look at the close-to-close prices. But during the week, Nifty made a high of 23,862 and a low of 22,930. That's a range of 932 points or close to 4%. The support levels mentioned in the last week's video at 22,900 worked perfectly, with Nifty making a low of 22,930 and seeing a pullback from there. So the support continues to remain at 22,900, followed by 21,750. On the upside, resistance is placed in the 23,900 to 24,000 zone and then at 24,350. The bias for the coming week remains bearish to sideways, but yes, you may see sharp moves on either side, an up move if positive news comes in from the US-Israel, Iran front, and a down move if negative developments emerge. Moving on to the daily time frame, Nifty formed 3 green candles on Monday, Tuesday, and Wednesday, giving bulls some hope for a recovery. But on Thursday, the index gapped down nearly 580 points or 2.5%, breached the 23,000 levels and made a new weekly low of 22,930 and closed the day at minus 3.36%. On Friday, it opened with a gap up and closed the day and the week at 2,314, gaining almost 0.5% for the day. This kind of price action tells you one thing. Lower time frame analysis is not very reliable in such conditions, and it's better to focus on higher time frames and key support resistance levels. On the daily time frame, supports are placed at 22,900 followed by 22,700. On the upside, resistance lies at 22,400, then 23,850 and the 24,300 zone. Since this week on Thursday, Nifty saw a close of more than minus 3%, the highest since 2024 general election result day on 4th of June 2024, when the markets fell 5.93%. Now, this has happened after 1 year and 9 months. So my quant mind always likes to put things in context, and I ran a quick test on Nifty to see how common such moves are. As you can see, a minus 3% close was not so rare pre-2009. But then came the greatest financial innovation of the century called QE, yes, quantitative easing, and since then we don't see such crashes often, barring 2020 of course. But you know my brain, it also asks questions. So the obvious question is, how do the forward returns look like after such a day? Say 1 week, 1 month, 6 months and 1 year later. So here's the data for you. It's self-explanatory that life is good most of the times if we could hold on for 6 months. But one should also understand that this is just a small sample and this year could be bad. Moving on to Nifty on an hourly time frame, the downtrend that started on 25th Feb finally ended on Wednesday after almost 3 weeks, making it one of the longest downtrends on hourly time frame in a very long time. However, post that, the market has started to chop around. Thursday's gap down wiped out a part of the gains from the earlier move, and currently price continues to sit well below 50 MA on the hourly time frame, indicating that the short-term structure is still very weak. Moving to Nifty's expected range till the upcoming weekly expiry on 24th March Tuesday, Nifty's 1DT ATM straddle premium closed to 452 points, down 48 points from last week's 500 point straddle. The geopolitical situation hasn't improved much, and the ATM straddle is currently pricing in a 1.95% move on either side. Based on the current straddle pricing, the expected range till expiry is 23,567 on the upside and 22,663 on the downside. That's roughly a 900 point range that is being priced in for the weekend and the 2 trading days thereafter. Looking at the upcoming Nifty weekly expiry open interest, on the put side, 23,000 put has the highest open interest going into the weekend. On the call side, 23,300, 23,500 and 23,800 strikes have relatively higher open interest. Once again, like last week, put open interest is higher than call, suggesting that the street is expecting the market to hold about 23,000 levels. So this 23,000 to 22,900 zone keeps coming up as a key support area. Let's see if it holds or not. Moving on to SENSEX on a weekly time frame, well, it lost just 31 points or 0.04% to close at 74,532, almost at the same level as last week. The candle has formed a tall upper wick, suggesting selling pressure near the 77,000 level, which continues to act as a key resistance, followed by 78,500. On the downside, support is placed near the weekly low of 73,900. The view for the coming week remains bearish to sideways, similar to Nifty. SENSEX on the daily time frame, well, the chart is similar to Nifty with 3 green candles at the beginning of the week, followed by a sharp fall of 3.26% on Thursday and a relatively sideways session on Friday. On the downside, supports are seen at 73,900, followed by 73,400. On the upside, resistances are placed at 75,350 and 76,750. Now, talking about SENSEX and its range, well, for the expiry, the next SENSEX weekly expiry is on 25th March, Wednesday, as Thursday, 26th is a holiday on account of Sri Ram Navami. The ATM straddle closed at 1710 points, down 368 points from 2078 last week. This implies a roughly 2.29% move on either side. Based on this pricing, the implied range for SENSEX is on the upside 76,243 and on the downside 72,823, which broadly places SENSEX in the 76,250 to 72,800 range going into the expiry. Moving on to BANKNIFTY on the daily time frame, BANKNIFTY gapped down on Thursday by 3.35%, largely driven by the news of HDFC Bank's chairman's exit, citing ethical concerns. On the downside, supports are placed at 53,250, which is the week's low, followed by 52,000. On the upside, resistances are at 54,100, 55,650 and 56,950. For the week, BANKNIFTY lost 331 points or 0.62% to close at 53,427. The weekly range was 2,313 points or 4.16%, lower than last week but still indicating elevated volatility. The overall view remains bearish on BANKNIFTY, largely influenced by the developments around HDFC Bank. On the hourly time frame, the downtrend that started in last week of Feb ended on Wednesday, but the price is once again below 50 MA, largely due to Thursday's massive gap down. Just like Nifty, BANKNIFTY also witnessed one of the biggest hourly downtrends in a long time, covering over 5,000 points. Now the quick question is, do we get another clean trend from here, or would the index move into a choppy phase again? Moving on to rate of change, in week 12, the red seems to be getting lighter across the indexes. Bank Nifty lost the most, you know the reason, and closed at minus 0.62%. Next was Nifty at minus 0.16%, and the SENSEX about 0.04%. And surprisingly, mid-cap Nifty ended slightly positive at 0.06%. I would call it flat though. The year-to-date numbers continue to be firmly in red. Sensex is down about 12.54%, Nifty around 11.54%, and Bank Nifty close to 10.33%, and mid-cap Nifty at about minus 8.36%. At this rate, it may turn out to be one of the worst March months post-2020. Talking about the sectors this week, well, all new top performers are new this week. Nifty Auto topping the list at 2.15%, then Metal at 1.06%, and then Consumption at 0.91%, and PSU Bank at 0.8%, and finally Commodities at 0.53%. Pharma seems to be taking a pause this week, but we have Auto, PSU Banks, and Metals which have made their appearance again. That's about it with the sectors. Talking about the range and expiries last week, well, the Nifty's average 5-day daily range stood at 365 points, up from 345 points last week. While Thursday saw one of the sharpest daily falls across indexes, it was Monday that recorded the highest daily range, as most of Thursday move came via an overnight gap. All 5 trading sessions this week saw ranges of over 1%, with Monday being the highest at 2.38%, followed by Thursday at 1.92%. Now let's talk about Nifty's weekly expiry, which happened on 17th of March, Tuesday. With a modest 84-point gap up opening on expiry, Nifty trended higher through the day, with one notable pullback of 221 points between 10:20 and 11:35. Before that, the index had already moved up 230 points, and after the pullback, it rallied another 300 points, breaking the day's high and closing at 23,581, up 0.74% or 172 points from the previous day's close. The ATM straddle opened at just 170 points, and the day turned out to be relatively easy for sellers, especially for those who built positions early in the session. Moving on to Sensex weekly expiry, which happened on 19th March, Thursday, with a massive gap down opening of 1,953 points or 2.55%. I expected option premiums to spike at the open. They were around 600, which may seem high, but not after such a large gap. Interestingly, the high and the low of the first minute candle were not breached until 2 p.m. And the range of the first minute candle itself was 668 points, higher than the straddle premium. Post 2 p.m., the index dropped 735 points and then recovered 550 points. So unless someone positioned themselves after 2 p.m., it would have been quite difficult to make money trading 0DT options. Moving on to India VIX for the week, it continues to inch higher week after week, gaining 0.74% to close at 22.81. While rising volatility may not be comfortable, especially since it usually comes with falling markets, this is also a phase that offers some of the best trading and investing opportunities. And hopefully, as always, this too shall pass and volatility will revert to the mean. Moving on to commodities this week, well, this week was similar to last week where both equity markets and precious metals fell. No action in crude and natural gas either. I mean, equity markets were flat, but precious metals fell hard. This is one of those weeks when market throws theory out of the window when folks say stuff like gold acts as a hedge. It does most of the times, but not always. Now look at the performance. Silver tanked minus 10.75%, gold is down 7.72%, copper down 6.27%, crude and natural gas are flat. Now that's commodities for this week. In summary, week 12 saw markets pause after 3 sharp down weeks, with indexes closing largely flat but with high volatility underneath. Intraday swings remain wide with multiple 1% moves, showing that uncertainty is still elevated despite a flat weekly close. Sectorally, there was a shift in leadership with autos, metals, and PSU banks outperforming while pharma cooled off. India VIX stayed elevated, keeping premiums high, and commodities saw sharp corrections in precious metals. Overall, the structure remains bearish to sideways, with markets trying to find a base but still reacting sharply to news flows. Moving on to what caught my attention this week outside of markets, well, I have three interesting recommendations for you. One is an article, and the other is a YouTube video, and the third is a meme. First is a news article published in the New York Times a few weeks ago titled "India Built the World's Back Office, AI is Starting to Shrink It." You see, for a good 25 years, India's economy thrived by providing a cost-effective, English-speaking workforce for global white-collar tasks. Today, it's a 300 billion industry that employs over 6 million people. However, the rise of AI agents, which can code, handle customer service, and manage many such tasks at a fraction of a cost, threatens to replace these human workers. As an active user of AI tools myself, it feels scary. Nonetheless, this is a good read to gain perspective on this AI-related risk. Next is a super nerdy video by Krish Ashok, one of my favorite creators. I know it's unfair to call him just a creator because he's so much more. But anyways, the video is about how simple laws of thermodynamics governs our life. Do watch it if it interests you. Lastly, I came across this meme and it's so damn true. Points so nicely to the irony of life. You can do all that you want, but something tiny and unimaginable can force you to alter your plans. I don't know who said it, but it reminded me of the quote which says, "If you want to make God laugh, tell him about your plans." Such is life. As always, links are in the show notes. Now over to what to expect in the coming week. Markets-wise, seems it's going to consolidate at these levels for a while, may chop around for a few weeks, let's see. Talking about trading days, the next week is a 4-day trading week. We have a market off on the 26th, that is Thursday, on account of Sri Ram Navami. Take a Friday off and you could get a long weekend for yourself. I wish I could do that. Anyways, because of the holiday on Thursday, the SENSEX weekly expiry shifts from Thursday to Wednesday, leading to back-to-back expiries this week. NIFTY on 24th Tuesday and SENSEX on 25th Wednesday. Looking at the events, there are no major known events lined up for the week ahead. As I said earlier, these are great times to invest in the indexes especially, and I'll leave you with this quote that I just made up. The arc of index investing is long, but it bends upwards. As I close, it just occurred to me that this week marks 6 years since 23rd March 2020, the day when the index closed minus 12%. But more than that, it's a reminder about how fragile our lives are and how vulnerable we are as a race, that a single microscopic entity could bring the entire human race to its knees and alter the course of history. Lest we forget. With that, we wrap up this week's weekly market metrics. If you find this series useful, don't forget to subscribe to the channel, and yes, do share it with your friends. Until then, stay curious, stay steady, and enjoy your weekend.